Let's go ahead and kick things off. Hey, it's so great to be with you today. I'm Micah Brandenburg. I'm the president of Legendary Exits. Excited to deliver this webinar to you about closing the profit gap. I want to go ahead and get some slides up on screen and get rolling. Nope, that's not the right slides. Let's take a look here and let's take a look. Boom. Here we go. Closing the profit gap. I'm going to go ahead and get our slides up on screen and then get started. So great to see everybody here today. Thanks so much for carving out this hour at maximum that we'll spend together. But I wanted to start this webinar and ask this key question. Why are you here today? You know, what was it that caught your attention about this particular topic that got you to show up today? Um, what is it that you want to learn as a result of this? I would encourage you to set an intention. What is it that you hope to gain out of this time as we begin to move through the content? Uh, if you've got questions that we're not answering, I want to hear those questions in the Q&A, in the chat. We want to get to those. But I'm going to guess that you're showing up here today because you want to build a better business. Or you're an advisor to business owners and you want them to build, you want to help them build a better business, a more profitable business. But we have to stop and we have to ask the question, what good is a more profitable business? What does more profits do for anybody? And I would just pause and answer that question and say, at our firm, we believe that business is about impacting people. It's not just about money. It's not less than money, but it's more than money. It's about impacting the lives of people. And so we exist to help business owners achieve a greater impact, and specifically to do that through business succession planning and business value acceleration. So in this webinar, what I want to do today is I want to address profit gaps. You might say, hey, what's a profit gap, Micah? Well, profit gap is the difference between your profits and what a best-in-class company in your industry at your revenue size is generating in profits. So just to break that down, if you're a $20 million top line company generating 10% in bottom line profit, that means you generate $2 million a year in profits. If best in class, the top 25% of companies in your industry are generating double that amount or 20% in profits, that means that you have a profit gap of $4 million. You say, hey, if your firm is so focused on impact, why are you focused on profitability and on closing the gap? And I want to get to that question in just a moment. The big piece that I want you to take away from this webinar today, if you take nothing else, whether you are a business owner or you are an advisor to business owners, is the key message that you see on screen. Closing the profit gap should be your number one foundational priority. I want to say it again. Closing the profit gap should be your number one priority or your client's number one priority. You might say, hey, Michael, we are focused on a phase of growth. We're focused on a phase of scaling. We're focused on a phase where we want to have a greater impact in the lives of our employees or our customers. We're growing towards a liquidity event and we want to increase our valuation. And maybe you feel that profits are secondary to all those focuses. What I want to help you understand is that it is not secondary. And I want to do that by sharing a story that might help you understand why creating a best-in-class business and closing your profit gap, so best-in-class being a top 25% business in your industry, I want to help you understand why creating a best-in-class business, one that is more profitable than 75% of all the companies in your industry, is foundational to every other goal that you have in business. You know, in 2007 at the Macworld conference, Steve Jobs stepped out on stage and debuted a device that was literally going to change our lives forever. In fact, I got the current model sitting right here to my right, and I very rarely go anywhere without it. What were the phones that were in market at the time that the iPhone was originally debuted in 2007? Maybe you remember the Trio smartphone by Palm. Maybe you remember those Palm Pilots with the styluses. I had one going back 25 years ago. And you would tap it and you would do all sorts of things. And they had a phone model and it had a stylus in there. Maybe you remember the BlackBerry. Anybody here remember having BlackBerry Thumb because you were scrolling through all your corporate emails back 25 years ago when BlackBerry phones were so popular? Similar to Tennis Elbow, people had BlackBerry Thumb from using that scroll button. But all those phones, they married a phone with email and with the internet. That was the essential premise of a smartphone back in 2007 before the iPhone. A phone with email and the internet. When Steve Jobs walked on stage that day back in 2007, he pointed out that every phone up until that point had a huge limitation. Phones up until that point had fixed plastic buttons, QWERTY keyboards. Remember that? You'd press the one key 3 times to get to the letter C. They had the QWERTY keyboards, or they might have other scroll buttons or literally fixed buttons that, regardless of what you wanted to do, whatever program you wanted to run on that smartphone, you had to use that QWERTY keyboard or those fixed plastic buttons. Or yet worse, you had to get that darn stylus out of the thing and actually tap the screen with it. One change, a buttonless phone empowered an entirely new generation of phones and of applications and of ways of engaging with our phones. One change, no buttons, just a touch screen. So instead of scrolling with the BlackBerry trackball, you could just touch the screen and it created infinite opportunities in the user experience. No more clicking up 5 times and pressing enter just to get done what you needed to get done. You could literally take your finger and just touch the screen and you could perform the exact same action that literally used to take 7 steps prior to that, whether it was weather, whether it was email, whether it was photos, all had different user experiences inside of the app. You know what enabled it? The lack of physical buttons, the touch screen. It was a very foundational element that actually empowered an entire better and new way of engaging with our phones. What I want to help you understand is that there's one thing that we have seen in our practice at Legendary Exits. If you want to call it a litmus test, there's one thing that we have seen that regardless of what it is that you want to do in your business, regardless of what it is that your client wants to do in their business, if you're an advisor to business owners, there is one thing that opens up all the possibilities, and that is profitability. You might say, and again, not just raw profitability, but profits as a percentage of revenue. You might say, hey, I want to grow my valuation, Micah. Well, I would say to you, closing the profit gap is key because most companies are valued on a multiple of annual profits. Best-in-class companies have the greatest valuations. You might say, hey, I want to have a greater impact on my employees. I want to serve my customers in a greater way. I want to have additional cash flows and profitability to put into R&D or greater client experience initiatives. You are going to need cash that comes from profits to do that if you are a privately held company without outside investors like venture capital backed companies. You might say, hey, I want to create a scalable business, one that can rapidly grow, one that maintains and even increases its profitability as it grows. I would say to you, you need a great business model with best-in-class margins because scalable businesses don't just focus on top-line revenue growth. They grow top-line revenue while maintaining and improving their unit economics and margins. That's profitability percentages. You might say, hey, I want to successfully exit my business. I'm 2 years out, 3 years out, 10 years out from that sort of transition event, whether it's transitioning it internally to my children or whether it's transitioning it externally like a sale to a private equity group. And I would say, how many best-in-class businesses, ones that are in the top 25% of profitability, do you know that don't ever sell? I haven't really come across very many. So the point that I want you to leave this opening part of this webinar with is that great financial outcomes, they stem from amazing operational performance. If you want to build an amazing company, one that somebody else wants to buy, one that has a greater impact in the world, one that can scale, one that someone actually will pay you a premium price for, one that has more profits now to do all sorts of things, then really the key issue for you is transforming your company to be a top 25 percentile company. And the number one issue I would point you to measure that is whether you are at, below, or above best-in-class performance for your industry. So how do we define best-in-class performance? Because if you want to close a profit gap, the first piece is you have to know if you have a profit gap, right? I can't close something that I don't have a vision exists. And so the first thing that I would just say to you is there's 3 core questions that you need to answer. And these are questions that just pragmatically you need to have an answer to in order to know, one, if you're best in class in your profitability, and two, if you've got some work to do to be able to close the gap. And the three questions you can see right on screen. One, do you know what best in class profitability is for your industry? If you're answering yes, I would ask you, how do you know that? A lot of people will answer that question and they'll say, well, I've been in this industry for 20 years. And what we really know, those of us who have the privilege to work with a variety of clients through consulting, is that very frequently clients suffer from echo chambers, right? We live in our own world and we think we're doing great, but we may not actually be doing great. And so I want to talk in a moment about external ways that you can confidently know what the top 25% in your industry is producing for financial outcomes. But the first question you need an answer to is, what does best in class performance look like? Second answer you need a question to is, what is your profitability? Not in raw dollars, but as a percentage of top line revenue. We can look at that a couple of different ways, whether it's net operating income or EBITDA. We'll talk about a little about more about that as we move through this presentation. But at the end of the day, you need to know what the percentage of profit is that best in class companies are pushing to the bottom line. And you need to know that not because it's a gut feel, but because you've actually looked at reliable data sources, right? You know what the best in class companies are doing. You need to look at your own financial statements to figure out the second question. And then thirdly, I would just say, well, what is it costing you? Whenever I talk with an owner, whenever we embark on a journey with a business owner who says, hey, I want to grow the valuation of my company to fully fund my plans for the rest of my life, and we decide that, hey, maybe the company's worth 10 million today and we need to take it to 25 million to do that, or maybe it's worth 5 million today and we got to take it to 15 million to do that. The thing that I'm always keyed in on is change is oftentimes tough. Change is oftentimes difficult. And so if we are going to help a client push through those difficult moments of change 6 months into the engagement when they want to turn back to the old ways that are easy. And by the way, we all do that, right? We all have a propensity to turn back and go back to our old ways. But if we want to help a client push through that, we need to help them quantify what's on the line. What's on the line in current profits, what's on the line in future valuation, and what does that mean for them and their family? We need to create, in short, a compelling why. There's no reason to change. There's no reason for you to go through the effort of engaging your leadership team and going through the work of transforming to be a top 25 percentile company if there's nothing in it. So is it greater profits today? Is it greater valuation for the future? Is it greater impact in between? Maybe it's all three of those things. But what exactly is it that you are losing? Maybe you're like a client of mine that I'm literally about to wrap up an opening 6-week engagement with tomorrow, who thought he was doing great as we recasted his EBITDA, something we'll talk about in a moment. As we looked at what best in class companies were doing in his industry, we found out that his current average performance has cost him over $2 million of profits over the last 3 years, right? And so quantifying the difference between what a best in class company is doing and where you are at and where you have been at is really critical to having a compelling why to move forward. I want to talk for a quick moment about how do we craft this vision of best in class performance. Again, a moment ago, I said, hey, a lot of us, particularly in sub 100 million in revenue companies, definitely in sub 50 million in revenue companies, we don't look to a lot of quantitative third-party sources. We tend to operate by gut intuition very frequently. So I want to walk you through just sort of 4 different ways that you can benchmark and actually set a standard of excellence of what the top 25% companies are doing in your industry. And by the way, this is the exact process that we leverage with clients. So first data source that we like to look at is we like to look at public companies. So the first thing I'm going to look at, or I would encourage you to look at, is I would say, hey, are there publicly traded companies in your industry, right? Maybe you're in marketing, maybe you're in roofing, maybe you are in construction, maybe you're in any various industry. The question is, are there publicly traded companies? Fastest way to cut through all that, go to an AI tool and ask it, right? But you say, Michael, why do you look at publicly traded companies as one of your 4 data sources? Well, publicly traded companies are legally required based on SEC governance to disclose their financials and to disclose their plans. They're an amazing source of intel. Now, they might be a $3 billion company and you might be a $30 million company, right? There are going to be differences. but they become a starting point. You can pull the annual reports, you can look at the quarterly reports, you can see the financial statements, and you can actually calculate what they are generating in profit as a percentage of revenue as a first data source. In addition to that, you can read the whole darn report if you have enough tolerance, or throw it into an AI tool and start asking it questions about the report, about what the plans are and how they achieve those outcomes. So that's the first place that I would look. Second place that I would look is third-party data sources. So two that we use in our business on a regular basis, they are subscription platforms. We look at IBISWorld and we look at ProfitSense. And so IBISWorld has, analysts that are tracking all the different industries by NAICS or SIC code, and they're putting out 30-page reports. They're looking at the public companies, they're looking at the private companies, they're looking at the meta trends in the industry. But one of the things that they do is they also track the financial performance. And so that's a second place that you can go to. ProfitSense is a peer submitted financial platform that has millions of financial statements. So for our clients, we'll go in and we'll say, hey, show me all the electrical contractors. We've got an electrical contractor that we work with in the Pacific Northwest. Show me all the electrical contractors who have revenue of a certain size, and I can literally see they're consolidated, not any one company, but I can literally see the average data of those financial statements. I can see what the average amount of profitability is. Third place that I like to go to is I like to go to industry and trade groups. Did you know that many industry and trade groups invite their membership to submit financials on a yearly basis? They will then aggregate and anonymize the data and publish a report to show the financial performance and the plans of what is happening across their membership. Again, great example. It's on the tip of my tongue just because we're about to wrap up a opening 6-week engagement with this client next week. Again, they're an electrical contractor in the Pacific Northwest. There were not great public companies to look at for them. From a third-party data source, we get some great information from IBISWorld and ProfitSense. But what was really interesting is that NECA, the National Electrical Contractors Association, publishes a report annually. And so we were able to go to their site, purchase that report, and actually glean some really, really great information from 150 companies that submitted their data to that trade organization and association. Last place that you can get a vision of what best-in-class companies are doing, and that is non-competitive CEO relationships. And this is one that if you don't already have this, I would really encourage you to develop these in your industry. So perhaps you're like another client of ours in waste management, and that client operates in a very specific geography. They are not nationwide. And so the opportunity for him as CEO is to develop relationships with CEOs of other waste management companies in different parts of the country where they are not competitive, right? Why would they do that? Peer relationships, the sharing of intel, but specifically on this particular issue, the sharing of financial performance. You say, would people actually do that? Yes, they do actually do that if you've got a personal relationship and if you're willing to share what your company is doing and the challenges potentially that you're experiencing and what's driving your own success. So 4 different ways that you can set that vision of best-in-class performance. These are the sources that we look to in our own business. Now, what's the challenge in all this? You call all this data, maybe some of these sources reveal information, maybe some don't. It's different sets of data. The challenge is that 2 main challenges that we see is the averaging of data and the sorting through all of this data. Averaging of data, why is that an issue? Well, if you want to be a best-in-class company, you don't have to be a data scientist to know that if you take 100 different companies and you throw them into a pot and you average their profitability, and that's what you're getting from some of these reports, you're not getting best in class. You're getting the average, right? We don't want to be average. We want to be top 25 percentile. That's the goal that we have with any client we work with, is to transform them to be top 25%. So one of the challenges that you will run into is average data. And that's where having access to third-party data sources that are willing to expose some of the raw data to you and literally show you all the values in the data set is super helpful. That's some of the things that we have access to through some of our third-party data sources. The other piece is just reconciling and resolving. There's lots of differences in all this data, from size of company to geography, et cetera, et cetera. One of the things that I will say to folks who are on this call who might be advisors, particularly in the exit advisory space, is the topic that we're talking about at hand today. Generally, a lot of the third-party tools that are seeking to address succession planning and exit advisory, they do not address this issue. And it is a massive missed opportunity because, again, the number one issue in a company being able to sell is being best in class. The number one issue in a company driving a premium valuation is being best in class in profitability. The number one issue in passing operational due diligence, once you've got a letter of intent, is being best in class. If you are best in class as evidenced by your financial outcomes, you are likely best in class in the way that you run your business, right? There's a correlation between how we run a business and what we see on the financial statements. And so I would just throw that out to you there, that if you're only looking at off-the-shelf tools that are seeking to value companies or assess maturities of companies, but you're not looking at setting a vision of best-in-class performance around profitability, you're missing a really, really foundational thing that can be fuel for your client's growth cycle and their valuation. I do want to talk just briefly about those differences, though, as you're looking to call that information real quickly, and then we're going to move on to a few other elements in this webinar today. So what are some of those differences that we see once we start to call the data? Value chain. You might look at two different companies, and one company might pick up the trash, and another company picks up the trash and they own the landfill. They're going to have different profit margins. That's owning different elements of what we call the value chain in business. Maybe you make the widget because you're a manufacturer, but you don't sell direct to the end user, right? If you make the widget and you sell direct to end user, like online mattress companies, then you own a lot of the value chain, if not the full value chain. The reason I bring this up is to say, as you begin to look at different reports, you have to have an eye to understand, hey, this company is different than this company in that it owns more or less of the value chain. That's one of the differences you'll see as you begin to establish that vision of best-in-class performance and profitability. One of the other things that you begin to see is there are differences between big companies and small companies. And there's a prevalent thought that really large companies, billion-dollar companies, are generating the greatest profit as a percentage of revenue. Not true. There often are companies, not again, they might be generating more in raw profit dollars, but when you take those profits and you convert them into a percentage of top line revenue, very frequently folks who play in niche markets, maybe it's not something that's scalable to create $1 billion business, but it's something that's scalable to create a $50 million business or a $100 million business, right? They can often achieve higher profit margins through addressing a premium segment that the larger company may also address, but is also addressing less premium segments. Last piece of the puzzle is I would just say, I also look at geographies. A lot of the data, if you can call it out by best-in-class companies, is again, a company in the Pacific Northwest in contracting is likely not going to be as profitable, in my opinion, as a company in the very desirable Southeast where everybody is moving to. Geographic location plays into pricing and profitability, right? But ultimately, if you do want to know what your profit potential is, all of these data sources are amazing places to look. They're a first step. But if you want to know what your profit potential is, you've got to move beyond benchmarks and you actually have to move into analysis and forecasting, which we're going to talk a little bit about in a moment. I do want to talk a little bit about the second part of those three questions. We talked about what is a best-in-class company doing? And then what is my profitability? I want to talk about my profitability on this slide. We're going to get to a couple of tactical strategies here in a moment, so hang with me. So how do you calculate your profitability? The key thing to take away as we're thinking about getting a clean number that companies are valued off of or even benchmarked off of for profit as a percentage of revenue is that the number that you show on your tax return or the number that you show on the bottom of your management prepared financial statements is the wrong number to be looking at. Typically, the number we want to look at is we want to look at EBITDA. Those who are finance folks, this is secondhand to us, right? Earnings before interest, taxes, depreciation, and amortization. But it's not just normal EBITDA, right? EBITDA seeks to add back in taxes if you're a C Corp. It seeks to add back in interest expense to normalize different ways of owning companies with debt loads. But we actually want to do a recast or a normalized EBITDA. You say, Michael, what is that all about? In a nutshell, this is what recasted or normalized EBITDA is all about. We ask ourselves the question, if I was to sell this company and I was not the owner anymore, what would need to change on the income statement in terms of expenses to reflect the new owner's experience? And so I'm just going to give you four of the top ones that I see really commonly in privately held companies where we end up leveraging recasting to normalize and to put ourselves and to make our financial statements look the way that they're going to look for a new buyer, because that's ultimately the number that our company is going to be valued off of and then we want to benchmark off of. Salaries, rent, discretionary expenses, and CapEx. So I'll just tick through these super quick. Two things under salaries. The first thing that you need to ask yourself, if you're the president CEO of your company and you own it, are you paying yourself a market rate wage? If you're paying yourself an above market wage, well, then we can reduce that, right? We can actually increase your profitability or EBITDA by reducing that, making an adjustment for it. Conversely, maybe you pay yourself below market. I had a call today with a client, a new client that we're taking through our opening 6-week engagement where we recast, and he's paying himself 150 grand a year, and market pay to replace him would easily be probably 225 to 250. And so we had to reduce his profitability to account for that difference, right? Maybe you've got family members that are on the payroll, not because they're really doing anything in business, but because you're paying family members. Maybe you own your real estate, super common for many entrepreneurs. You own it in a separate holding company. And so again, the question is, are we paying ourselves market rent? Are we renting it below market or above market? We want to make adjustments for that, right? Because if you sell the company, you're going to want that new owner, unless they buy the real estate from you, to probably pay a fair market rent to you. We look at discretionary expenses, things like golf club memberships, personal travel, personal automobiles, planes, right? I've seen all sorts of things that owners expense through their business, and I don't pretend to critique it as right or wrong inherently. I just seek to understand it with an owner and say, hey, this is what needs to change to get to that clean number to both value and benchmark your business off of. Last one that I see, and this is a really, really common one, and so I'm going to pause here for a moment with companies who have a significant amount of equipment or a significant amount of vehicles. I have seen this with 4 different new clients that we've taken on over the last 2 months. And this is the issue. And again, it's not an issue, but it's a significant difference in how we have to recast or adjust for EBITDA. If you own a significant amount of your fleet or vehicles free and clear, that means you don't lease them and you don't have debt on them. So you own them free and clear, or a very significant percentage you own free and clear. Your cost to operate that fleet may not be market rate costs, right? You may be benefiting at the current time from a compressed cost to operate that fleet. I love it. I love your strategy on it. But the question is, when a new owner comes in, is that what they're going to do? And the answer for the most part is going to be no, because you're not going to want to give them all the value that you've built up in that fleet. You're going to want to see them lease a new fleet. You're going to want to see them buy a new fleet. You're going to want to see them, you're going to want to see yourself ultimately take the net worth that's in those vehicles and extract it out of the business for yourself. As an example, I've got one client who's easily got $750,000 of tangible net worth in vehicles in the balance sheet. They're benefiting from greater profits, lower operating costs. Got another client, almost $2 million of free and clear vehicles on the balance sheet, no debt, no leases, right? Benefiting from lower than typical operating costs. And so we just have to account for that as we think about calculating our profitability number, what we call recasted or normalized EBITDA. By the way, I want to pause here just for a quick moment. I know we're about 30 minutes into our webinar, and I'm about to dive into some very tactical ways now that we've talked about setting a vision, and now that we've talked about literally how to calculate your own profitability level. Well, hey, if I do have a gap, I get to that third question. I know best in class is 25% profitability. I'm at 17%. I want to close the 8-point gap. How do I do it? That's where we're going literally in about 2 minutes. But I just want to pause here for a quick moment. If you've got questions on anything that we've covered, hey, Micah, how does this apply to my business? Hey, how does this, I had this question, I didn't see you cover it. Drop that into the Q&A function. We're going to have a good Q&A here at the end. Love to get to your question. Feel free to raise your hand as well when we get to that point in time. But if you've got a question we haven't addressed it, go ahead and drop that into the Q&A. We would love to be able to give you some customized advice to help you get clear on your own situation. Last item here, as we start to get into some tactical plays and then push to the close of our webinar today, I would say there is a way to close a profit gap. So if you say, okay, I've gone through this process, or maybe I've just got a hunch that for me or for my client, we're not best in class, right? And so you got the hunch and you know you got to go and you've got to do the work and you've got to do the third-party data sources, the 4 different ways that we've talked about. You know you've got to actually look at the financial statements, but you got a hunch. You say, Micah, is there a right and a wrong way to close profitability? And what I would say is, in my opinion, there is. And when I look at a company to increase margins, when I look at a company to increase their profitability, a lot of times folks who maybe haven't done this in their career, they think that the way to get to greater profitability is to cut expense and to cut operating expense. And I would say, if you're doing that, that is the wrong starting place. Let me be super clear on that. That is the wrong starting place. What is the right starting place? The number one place is to start on the income statement with cost of goods sold. So I just want to back up real quickly. You might be on this call, you might be a financial wizard, you might have worked in finance for a long time, you might be a business owner fluent in finance, but it's just not the piece that you deal with every day. I want to make this really clear for you. You have 3 core financial statements. One of those is an income statement. A lot of times folks call it a profit and loss statement. A lot of numbers show up on there, the revenue and the expense. If you really break it down on a well-prepared one, there's only 3 sections. There's 3 sections. That's it. We get the revenue that we have earned and recognized at the top. And then we get 2 different expense sections. We get the cost of goods sold and we get our operating expense. You say, what's the difference in those? The cost of goods sold is everything it takes to make the widget. Or if you're a services company and you pick up trash, it's everything it takes, including the labor and the trucks and all of that, to literally go pick up the trash cans and take them to the dump, right? So cost of goods sold are direct costs, if you're familiar with that concept of manufacturing. What does it take to make our product or to render our service? Operating expense is really our overhead, sales expense, marketing expense, our building, these sorts of types of expenses. So now that we've broken down the income statement into 3 sections, what I would say for you is I always focus on that second section. I don't focus on revenue first. I focus on expenses and COGS, right? Then I go up to revenue, then I'm down into operating expense. And I'm going to share with you 4 of my top plays here in just a moment, very tactical ones that you can look at for your own business or you can encourage your clients to look at for their business. But order of operations, income statement first, cost of goods sold, then move up to revenue, then move down to operating expense. That typically is where I like to see profit gaps closed in that particular order. One other insight that's really interesting is when you jump over to your balance sheet, which is very underutilized for most companies, I like to calculate the return on equity metric. Hardly anybody calculates that unless you are larger than $100 million of top line revenue. You say, Michael, what's return on equity? Return on equity is a concept that you would ask if you're looking at your business as an investor would look at it. It's the equity in your business, sort of the worth in your business, and we take that and we divide into it our net profit for the year. We're generating so much profit, but we've got so much worth in the business or equity. What kind of return am I getting? Is it single digits? Is it 12%? Is it 30? Is it 50? Right? Just like you would think about getting a great return on money that you invest into the capital markets, into stocks, into bonds, those sorts of things, into mutual funds, you want to begin to think about your business as your greatest investment. This is a really revealing metric, by the way, that most business owners I speak with are very surprised when we end up calculating it together. And they are not generating the level of return that they should be. That's generally because they hold too much cash in the business, they have too much assets on the balance sheet, or thirdly, they're generating too little profit as a percentage of revenue. All 3 of those things play into return on equity. I do want to now go into tactical plays. That was the subtitle of this webinar, and maybe that's why you are here. Micah, I know I've got a profit gap. I've got a client that I'm pretty confident has one. Tactically, how do we go about doing it? I understand the process of setting the vision. I understand the process of calculating where they're at or where I am at on a profit percentage basis. I know that those 8 percentage points of going from 17% to 25% is costing me $1 million a year, like one of my clients who is a $13 million a year services company. But how do I do it? Let's dive in. And this is what we're going to cover, and then we'll move to our Q&A. First thing that you want to begin to look at is pricing increases. You say, can't do it, Micah, I'm going to lose clients. I would say, before you tell me no, let's talk about it. The average small business has not done a price increase in 5 to 7 years. Think about that. Think about how long ago COVID was. COVID was this month 5 years ago, right? Literally right now, we were all in lockdown in COVID 5 years ago. Is anything the same price today as it was 5 years ago? No. Everything that I know that me and my family uses is far more expensive today. All those supply chain issues we saw in COVID, they've never gone down in price ever since then. Um, and so I would just encourage you that pricing is your number one lever. You don't have to sell more, you don't have to do more. You just have to charge what you are worth. What I would encourage you to do if you're fearful about pricing is I have a podcast called Legendary Exits, and I interview both exited entrepreneurs and folks who guide them. I have a new podcast dropping tomorrow with Casey Brown, who is a pricing execution expert. And you need to listen to this podcast. Casey has a TED Talk that has been viewed 4 million times, has keynoted at the EOS Worldwide Conference, and has a book that was written 3 months ago called Fearless Pricing, which you would do well to pick up. But that podcast drops tomorrow. You can find it on YouTube and other platforms. But I would just say to you, you really need to think about raising prices. Pricing is a psychology issue. And oftentimes, the person who is the most fearful about raising prices is the seller. It's not the buyer of the product. So if you're really doing something amazing, if you're really doing something excellent in your business, you ought to be paid excellent prices to do it. And if you don't, that's an injustice. And so I would just challenge you that pricing is your number one lever to increase profitability. Second lever to increase profitability, by the way, all these are under COGS because pricing increase is going to increase my COGS. Or pardon me, it's going to increase my gross margin, which is the output of COGS. But second thing that I would encourage you to think about is thinking about reducing the costs of your inputs to cost of goods sold. Again, a minute ago, I said cost of goods sold. That's that second of third things on the income statement. That's our expenses that are directly associated with making our widget or rendering our service. For most companies, those are going to be raw materials. I have a client in roofing. That's going to be some of the roofing supplies that they're literally putting on a roof. But the second thing, that's going to be the labor of the guys who are literally getting in a truck each morning, driving to the job site and doing the work. It's also going to be the assets and it's going to be the equipment that they use, right? And the trucks that they drive to be able to get there. And so, there's opportunities here to renegotiate sometimes pricing with suppliers. There's opportunities to say, hey, are we paying market rate wages? Are we being efficient in the work that we're getting done? And I'm going to talk about that in the third bullet point in just a moment. And then thirdly, just the assets that we use in the process of making our widgets or rendering our service. So again, I'm gonna walk through a couple examples and bring this to life in just a moment with two different clients before we go to Q&A. But third thing, that is a tactical play to increase profits. And to be clear, after pricing, this is probably my second greatest lever that I always run in my playbook. It's utilization rates. You say, Michael, what are you talking about? And here's how I would explain it to you. Every company has a system of production, right? Doesn't matter if you make widgets or if you go out and you spray lawns with chemicals, right? One makes a product, one renders a service. We could switch those to anything out. You can make snack food crackers. You could be a marketing agency who is rendering services, right? But every company has a system of production. So let's take the widget manufacturer for a moment. What's the constraint? Well, the constraint is I got a building, and that building can only have so many manufacturing lines in it, right? That's why we optimize floor plans in manufacturing. And then the next question is, how quickly can I move products down the line? And then the next question is, how many hours a day do I run the line, right? And so what we can begin to do as we understand the answers to those questions is we can say, I got a building that's so many square feet with so many lines, and I move so much down it, and I could hypothetically run it 24 hours a day if I could staff it, right? With 3 shifts. What is my potential to generate revenue with that system of production, right? Secondly, when I understand the potential to generate revenue, what am I actually generating in revenue, right? What is the difference between those if I factor them as a percentage of one another? If I could get that percentage higher, how much more money would it drive to the bottom line? What you typically see with utilization rates is there's opportunities to increase the quantity of revenue through a system of production, but push a higher percentage of profit to the bottom line. Why? Because we're already paying the mortgage payment on the building. We're already paying and have made the investment into those manufacturing lines, right? We're just paying, if we're making Coca-Cola bottles, we're just paying for more glass. We're paying for more people who might work on that line. But we're not paying the same amount for the building and the manufacturing lines again. And so the more product I put down it, the higher the margins are I get in that product. And that's a significant play. Let's jump over to a services business. Maybe you're a digital agency. Maybe you're a construction company, right? A roofing company, as I mentioned, one of our clients is. You can do the same exact thing there. Your system of constraints is not a building with lines. Your system of constraint is you might have a facility, and guys and gals might gather there every day, and then they drive trucks out of there and they go do stuff. And so it's, well, how many of these trucks can I operate out of a facility? And then how many folks do I need on those trucks? And so therefore, if I can get them optimized with the right routes and doing the right things, what's the potential revenue we can generate off of each truck each day? Are we going to run them 5 days a week? Are we going to run them 6 days a week, 7 days a week? I don't know the answer. But these are all the things that if you're trying to create an idea of potential revenue for a services company, you want to look at the existing footprint that's already been invested into, right? Very frequently, very frequently, you will find that companies are underutilized. I have one client who they're at 51% utilization. By the way, generates several $1 million a year to the bottom line, but they're at 51% utilization. We figured out that just moving them to 60% utilization would add another $1 million to their bottom line. And the goal is really to get to 70%, right? So just a lot of different examples, but this would be a third play in the playbook is utilization rates. Raise prices, don't be fearful. Two, renegotiate the costs of what it takes to make or render your service. Three, become more efficient. Utilize that system of production in a greater way because you're already paying for it. And I guarantee you that unless you're already doing rigorous reporting, rigorous tracking week by week, you likely have ways to push out an extra 5, 10, maybe even 20% of production through that system of production and push a lot more money to the bottom line. Fourth way that I would say is now I do like to look at an operating expense metric. That's that third place on the income statement. And I like to look at operating expense as a percentage of revenue. What we sometimes find is that companies overhire too quickly, right? We're building out, teams that aren't involved in making the widgets or rendering the service that are too great to support the infrastructure of what currently exists. And so a great way to think about that is to go again through benchmarking and say, what are best-in-class companies doing? What are they spending on operating expenses as a percentage of revenue? What are we spending? Oftentimes optimizations there, we've got to make two decisions if we're not best in class on that. One, we've either got to grow the size of the company to right size to our overhead, or two, depending upon how quickly we can grow the company, or maybe a lack of desire to grow the company, we've got to downsize operating expense to be in the right relationship to our top line revenue. So to me, those are the four big power plays, right? Many other plays that you can do to increase profitability. But I would just say, if you want to build a scalable business, if you want to capture profits as fast as possible, in my experience, these are the four big plays that I leverage in our playbook with companies. I want to just take you through now as we think about, and before we go to Q&A, I want to help you sort of visualize this process by just walking you through two different clients that we have the privilege to work with. I'll just tell you a little bit about their industries and how this sort of process that we just talked about today played out for them. One of the clients that we work with is a marketing and advertising agency in the Southeast. They do about 13 million in top line revenue. How do we set benchmarks for them? Well, again, as we go back and we thought about, how do we set benchmarks right here, the four sources, there really wasn't great public company data for this particular client, which was in marketing and advertising. There wasn't great peer CEO relationships that the president of that company had with other peer CEOs to be able to call that data. What we did have access to is third-party data in some very specific, it wasn't industry reports, but rather it was a third-party data set from an M&A group that specializes in marketing and advertising agencies. What we found out as we recasted was a couple of different things. One, because that was our next step, as we recasted, we found out that one, there was a lot of owner expense that was flowing through the business. Family members on payroll and discretionary expenses to the tune of well over $1 million a year. And so that obviously influenced our recasted EBITDA. We figured out company was at 17%. You say, what is a best-in-class marketing and advertising agency pushing? A minimum of 25%. Some are doing 30, some are getting as high as 40 through different plays, but 25% is a solid place. What we figured out was that 8-point difference was worth almost $1 million a year in bottom line profit off of the 13 million in top line revenue. You say, hey, Mike, it's one thing to set the vision of 25%, another thing to recast and know where they're at and to see the diff, but what actually is closing the gap for this particular company? It's really two issues, and I've already talked to you about them on the last slide that we went through. Pricing increases, and second issue was utilization rates. So pricing increases were something that this marketing agency had done a little bit each year, but they needed to do it again in the coming year. But the big driver for this agency was utilization rates. And so as we began to look at their system of production, we began to realize that they were at 51% utilization. In that a feasible utilization rate was likely 70%, but just moving the needle from 51 to 60 would add that $1 million to the bottom line. You say, hey, that's great, but how do you do that? It's one thing to know that utilization rate is the issue, but what are the plays, what are the plans that they executed on to actually capture that? And really what we found was this: the org chart was broken. It was laid out wrong. There were too many chiefs and not enough Indians in that sort of word picture. We had an org chart that didn't empower and had people in too many meetings. And there was just a culture, a silent culture that was dragging down the efficiency and the ability to do more work for clients. And so that was a key issue that this organization had to tackle. Another story that I'll tell you super quick, and then we'll move to a Q&A time, is we do have a client who is a commercial moving company in the Midwest doing, just shy of $10 million a year in sales. And they came to us thinking that they were doing really well, but wanted to explore succession planning. And specifically, they were pushing about 11% in net operating income. Well, when we set their benchmarks with third-party data sources, right? So again, we're back to how do we set a vision? Not really great public companies out there in this particular segment. There are some larger codes that we called some data from. We did pull third-party data sources. We did have some peer CEO relationships to look to. There were no industry or trade group reports. But when we did that, we set a really clear standard of almost 15% in net profitability. And I think that's conservative. We think that there's an opportunity to go beyond that, but we set a best-in-class vision at this point of 15% minimum. The real interesting piece came when we recasted their EBITDA. Remember, I told you there's a difference between the number you show the taxman and the number you value off of or benchmark off of. And one of the two big differences with this company were, one, they were including one-time tax credits, the employee retention tax credit specifically, in their profitability of 11%. You say, why is that a problem? Because when somebody goes to buy a company, they don't want to buy one-time revenue sources. They want to buy ongoing ones. So you got to strip it out. Second big issue for this organization, Um, Large fleet over $2 million, owned free and clear, no debt. And so again, they're enjoying reduced operating costs. But realistically, a new buyer who comes in is going to lease or need to put debt on that to be able to finance that fleet. And so we had to add that expense back as well. So really, when we finished our recast and we figured out that an 11% company came all the way down to just shy of 5% in recasted EBITDA. As we thought about that difference between 5 and 15%, that's huge. It's $1 million a year, right? Coming back to, what do you want to do? Do you want to have a greater impact? Do you want to drive your valuation, which is always at a multiple of profits, right? Unless you're a high growth tech SaaS company. That's 4 million at a 4 times multiple. That's $4 million more in valuation just by growing and closing that profit gap of $1 million, right? So all sorts of different plays that are there. But again, how did we do it? Utilization rates and gross margin by product line. This particular company has 3 different product lines. They actually have some warehousing that they do for commercial clients as well as consumers. They do the core moving business, but they also resell some office furniture. But the challenge is their financials are all commingled together and they cannot tell utilization rates or gross margin by each of those 3 product and service offerings. When we were able to break those out, it creates a lot more visibility, right? Our target EBITDA percentage and gross margin percentage is going to be different on the moving business than it is on the warehousing business. So creating that clarity and then focusing in on utilization rates for both is the plan for capturing the profit gap there. I hope those examples are helpful to you. And with that, I do want us to push to the close. And I want to just talk about a real quick way that we can help you and we can help your clients, and then open up with Q&A. And I'm going to ask Jenna on my team to help me with that. So by the way, if you do have a question, you haven't put it into chat, go ahead and click the raise your hand button. You should see it on your interface and we'll just pull you out on screen and let you ask your question. But 2 ways that we can help you. Everything that we've talked about in this webinar here, it's one of 3 things that we do in our core opening 6-week engagement, which is called an exit clarity engagement. We intake financials, we do trend analysis, but the core thing that we do is we value companies, we benchmark them, everything that we've talked about in this particular webinar today. And we assess those companies, assess them specifically around whether they are attractive to acquirers and whether they could pass due diligence when they go to sell their company without retrading their LOI, which is code for the buyer driving down the price. So if you're interested in that, or you're a client in that, our work generally is multi-year engagements, but we say, give us 6 weeks and we will find all the profits that we need to fund our engagement for the next 3 years. And as we talked about benchmarking today, and we talked about the gaps of millions of dollars or hundreds of thousands of dollars, I'm sure it's not easy. I'm sure it's not difficult to understand why we would say that we find all the profits that we need to fund our engagement in that first 6 weeks. If you're looking specifically for help just around benchmarking, we're happy to chat with you about that as well. Whether it's you, whether it's a client, feel free to book a call. You can go right on our website and you can do that there. With that, Jenna, do we have any questions in our Q&A? Do we have folks who've got a hand raised that we want to bring on screen?
Yeah, we have a question from Jackson. So you mentioned the danger of using third-party tools to compare profitability. Could you expand on that a little bit?
Getting a sip of water, Jackson. So Jackson, first off, great. Thanks for coming today. So the first issue in my comment on that, just to be super clear, is most tools, and this is a very narrow response for folks in this call who are advisors to business owners around succession planning and exit advisory. And there are a lot of tools in the marketplace. I won't name them all off, but there are a lot of tools in the marketplace that seek to assess companies and help you understand their valuation. The challenge is I have yet to see any of those tools that actually pull in this third-party data sources around benchmarking. Some of them seek to do it around valuation, but I would say the biggest opportunity to move valuation, right, is to help your client understand why they would want to change. And the number one issue that we find coming out of that 6-week engagement is that missing profits. That is really painful, right? It's also really motivating. It's like, man, what would I do with this extra $1 million? Would I pay it out? Would I take my family on more vacations? Would I, do something for my employees? Would I give it to causes and charities I'm passionate about? But to be really clear in the response, Jackson, I would say, um, you know, I haven't seen any of these exit advisory tools that actually are pulling in um, income statement based benchmarking data to help you discern EBITDA as a percentage of revenue and what best in class is for your client for that industry. So a little bit long-winded answer, a little bit specific answer. I don't know if that answers your question or if you might have a follow-up to that, Jackson.
I just saw a little thumbs up come across the screen, so maybe that was Jackson telling
Yeah.
us that that
So
was
super clear. A lot of those tools that I referenced, great starting points, great places to start the conversation with clients, because Jackson is an advisor to clients who are business owners. But I haven't seen that capability in any of those tools. So back to you, Jenna.
great. Yeah, so we actually had a few people that could not make it today, but submitted some questions in advance. So Jackie had asked, how do you recommend prioritizing between pricing increases and cost reduction initiatives when you are working to improve margins? And is there a particular sequence that tends to be most effective?
Uh, Pricing increases versus cost reduction. So obviously Jackie wasn't here with us today, but this would really flow into the slide that I had around order of operations and starting with cost of goods sold and then revenue and then operating expense. And so 100%, Jack, as we get that response back to her, I would say pricing increases are a greater priority than cost reductions. And then, of course, I would look to the raw material inputs that we talked about. Then, thirdly, I would look to utilization rates. Then, fourthly, I would look at my operating expense. What percentage of revenue is it? Is it at the right place? If not, are we going to increase sales to get it to the right percentage? Or are we going to end up making those reductions to bring it in line today? And so that's how I would answer that question. Great one.
Awesome. We have another one from Sarah. They've tried margin improvement initiatives before, but they didn't stick long term. What accountability systems have you found most effective for ensuring sustainable results?
Mm. So sustainable results is our goal. And I agree that that should be the goal. I think if you've done margin improvement initiatives or you've attempted them and they haven't stuck, they haven't worked, I think there's a couple of things at play here. I think there's probably a lack of clarity that is shared amongst the leadership team and everybody in the company that this is our priority. One of the things I love to do with a company that I engage with is I like each quarter to set a singular financial priority. Again, the way we make financial better is to focus on go-to-market and operations, but I like to set a single financial priority for the quarter. So if it's margin improvement, I like to see that called out. I like to see everybody on the leadership team embrace that, communicating that down to their team. But then obviously a plan developed about how we're going to achieve that, and then reporting that we're reviewing each week in staff meetings. That's really holding us accountable, and we're actually saying, hey, we missed our goals this week. Why is that? What do we need to learn from that? And again, the team, not just one person, but the team coming together and rallying around that to solution and to figure out what we need to do to get back on track. So that's how I would approach that, and that's how we typically approach that with clients to make sure that improvement initiatives aren't just a one-time thing, but they turn into ongoing ways of being and ongoing ways of doing as a company.
Awesome. And lastly, from Tyler, we have, how long does it typically take to see meaningful results from this process? And are there any quick wins you recommend focusing on first to build momentum?
Mm, yeah, great question. How long in quick wins? Yeah, how long? I would say the fastest that I've ever seen somebody dramatically move EBITDA as a percentage of revenue, right? And not just like a click up or that sort of a thing. Probably is 3 months, but 3 months is really fast. Why is that? I would say the average is probably 6 months, maybe 6 to 9. Um, because you have to think about the fact that you're doing discovery, you're realizing that you have opportunities to improve. Then there's time to develop the strategy and the plan and the resourcing. Then there's time to execute on this. And then there's a delay between executing and seeing results. And then let's layer a last concept on top of that. Maybe part of the strategy is to increase top line revenue, right? Well, now we have to get into, well, how long is your sales cycle? And let's say you're a B2B company and your average sales cycle is 90 days. You could easily be in the 6 to 9 or even 12-month mark, right? So shortest is 3 months. I would say 6 months, you can definitely start to see some things, but a lot of it is tied to what kind of initiative is going to increase profitability. And there are just other factors at play that we'd have to get into on that. So good question. Jenna, any other questions in Q&A or hands raised that we need to address before we wrap?
No, I think that concludes our Q&A.
Well, hey, everybody, so great to have you with us today. We was a delight to be with you. If we can help you, if we can help if we can help a client that you are working with, please reach out. We'd love to chat, love to have a conversation. But have a blessed evening, and until next time, we wish you well.